Hi, and welcome to this week's edition of Reverse Mortgage Weekly, where I, Zach Smith, your host, go over and answer any questions that you might have about the reverse mortgage and really just kind of explain and try to educate as much as possible in regards to this program. You know, there is so much misinformation out there about this program. And really, what I think it is I think it stems from people because this program is basically designed for a protected class, which are older adults. You know, older adults are taken advantage of on a daily basis. They are targets for telemarketers, targets for cybercrime, all of these different things that happen in this industry for the older adult. So I think that whenever there's a program that's not associated with healthcare or some type of care, that people look at it, oh, it's a scam. It's just something to take advantage of for older adults. Again, you know, my purpose, my goal, my wish is that more people were educated about this program. Not so much so it will drive business to me. Of course, this is how I make a living. This is how I put food on the table. But you don't necessarily have to go through us for a reverse mortgage to reap the benefits. There's a lot of talented people out there that know how to structure these. There are also a lot of people who may be very new to the business, basically fake it till you make it, you know, which I understand. We all start off somewhere. But I think the more people that look at this program, and, you know, it's not a good option for everybody. You know, I'm not going to try to sit here and say, oh, it's a great option for everybody. It's not a good option for everybody. And really, if you look at some of our past videos and how we've looked at this prior, time is really the determining factor for that. How long are you going to be in the house? Because if you're not going to be in the house a very long time, it's not a good option for you. Or if, you know, the house is maybe not the right house for you. What if, you know, you want to get a reverse mortgage on a home, but it's got stairs that, you know, in a year to 5 years, you may not be able to traverse those stairs, or maybe it's not set up for aging in place. But if you're going to age in place, which all the statistics show that you do much better, you're happier, healthier if you age in place and not in a facility or in someone else's house or something like that. But if you are planning on aging in place, in my opinion, there is no better program on the face of the planet than the reverse mortgage. So let's get right into it here. Once again, my name is Zach Smith. I own Chariot Financial. You can reach us anytime, 24 hours a day at chariotreverse.com, chariotreverse.com, chariotreverse.com. 3 times the charms, right? So let's go ahead and dive right into it. So why are people taking these out? What are the benefits? You know, it's like that commercial in the 80s. You know, where's the beef? Where's it at? Well, number one, the main reason people take out a reverse mortgage is an increase in cash flow. You know, an optional payment or tenured payment where the mortgage actually pays you back each month. It's not a very popular option. Just because you don't really get that much back. Most people are taking these out to take their current mortgage that is, you know, monthly payments that they're paying each month. And again, you know, if you look at a 30-year amortized loan, most of your monthly payments are going right towards, let me hear it, interest. Yeah, the 30-year fixed loan is a bad deal. And I mean, what else are you going to do? I mean, of course, you know, a lot of folks, you know, like I'm a big fan of the all-in-one programs. A lot of banks have tightened up on those, though, and some of them don't even offer those anymore. Basically, it's a simple interest mortgage where you pay, you know, you don't pay an amortized schedule. But, you know, on an amortized schedule, you're paying 50% of the interest in the first 10 years. So, you know, a lot of folks, oh, I got this really low interest rate. Well, you're still in an amortized schedule. So basically taking what you'd normally be paying on an amortized mortgage and converting that to a payment optional. So let's say your principal and interest payment is $2,000 per month. I know that's pretty low for people who've gotten a mortgage in the last year or so, but $2,000 a month. Let's say the next day you converted that into a reverse mortgage. The reverse mortgage would pay that off. And guess what? here's the thing that I would really like to impart with people. If you want to keep paying $2,000 a month and pay off the house, go for it. Go for it. You don't have to do a negatively amortized loan on a reverse mortgage. If you want to treat this just like any other loan, you can. You're just not forced to. So you have the option. You can continue to make your monthly payment, or if you want to take that $2,000 and maybe put it in your pocket, because again, if you take $2,000 and you just got into your amortized loan, probably about $200 or $300 of that is going towards the actual paying down of the principal. The other $1,700 is going to the bank. So I mean, it just, to me, I think that's just a little silly. If you want to make that amortized payment, you can, but you're giving it over to the bank where you could be putting that in your pocket. Now, let me ask you a question. If you took that $2,000 and you put it into an investment vehicle, how do you think you would make out at the end? Of course, time is part of that equation. But would you rather pass on equity, or would you rather pass on a higher net worth to your heirs? Again, questions that I like to ask folks, because I don't think people are asking these questions when they think about this program. Number 2, asset protection. Folks think that, the only reason you get a reverse mortgage is so because you can't afford your payment, or you need to pay off debt like a car loan, student loans, credit card debt, mortgage. You can pay off all of that debt. You can roll it into the loan. You can just basically roll it into the loan. You can do that with a reverse mortgage. But guess what? We have several folks who take these out who own their homes free and clear. Why? Because they want a safety net. They want to be able to access that equity. Equity is really nice to have, but it's a lot like having a coffee table full of cash, right? The glass coffee table right there in the middle of your living room full of cash that you can't get to. Because in order to get to that equity, you got to either sell the property or you got to get a loan. And a lot of times loans come with payments. Now, the reverse mortgage loan does have a payment, but it is optional. It's not something you have to come out of pocket with. So, and number 3, it's a non-recourse loan. So you're never going to owe more money than the house is worth. A good example is in 2008 when, we had a big housing market crash. And by the way, people are not expecting that to happen this time. I know I have clients that are saying, oh, there's going to be a big crash, waiting for the bubble to burst, because they remember in 2008 when property values plummeted and the Great Recession followed thereafter. Well, I don't know. I think there's a roaring demand right now. And I'm not alone on that opinion. There's a lot of professional folks out there. Barbara Corcoran, I'm sure you guys know of her. She's on Shark Tank and all that. Very shrewd businesswoman, very shrewd. She was talking about that earlier in the year and said she thinks prices are going to go through the roof if rates go down. And I'm of that opinion too, because there's a lot of pent up demand with people living at home or basically haven't been able to buy because the rates are so high. I mean, starter homes right now, you're looking at like a $4,500 payment here in Colorado. Starter home. So it's really putting the squeeze on a lot of folks. And if we get a little bit of reduction in rates, I mean, the floodgates are going to open. That's my opinion. So number 3, folks take that out as a safety net for their assets. So if we're in a bear market, which we might be, if there's a recession coming, who knows? Then people, instead of taking out of their line of credit or of their investments, they'll take out of their line of credit so that they can secure their wealth. And we're going to go over some details on that later in the class today. So it doesn't require repayment until the last living borrower leaves the home, either by passing or selling. The heirs have 6 months to decide what to do with the property and can apply for 2-3-month extension periods. And they'll sell it to their heirs for 95% of the appraised value. Now, I got a call today that said that folks were having a hard time selling their properties because they had a reverse mortgage. I've never heard of that in my entire life. It is something I'd like to investigate, but This is one of the most friendly properties or friendly programs when it comes to that situation. On a forward mortgage, if you're not able to make those 3 monthly payments, let's say your parents pass away or you pass away, well, you've got to make those 3 monthly payments. If you don't make 3 monthly payments in a row, and who's going to make them? Is it going to be your heirs? Are they going to be making them? Or, who? But if you go 3 months delinquent, they can start the foreclosure process and basically sell the property at that point on auction through a foreclosure. Reverse mortgage is not like that. It is a program that's very friendly in that situation. So great way to purchase property. People would really, people really like purchasing property as this because they want to stay liquid. Let's say you want to purchase a $400,000 home. You don't want a monthly mortgage payment. So what do? Traditionally what you do is you take $400,000 out of the bank, put it all in the property, and then you don't have a monthly payment. But guess what? You don't also have. You don't have $400,000 now. All that $400,000, you lost all control over it. Why? Because you put it in the hands of a bank or you put it in the hands of a buyer. And what do I mean by that? Well, if you want to get it back out, you got to sell the property. So you got to find yourself a buyer. Or if you want to get a portion of it out, you got to call a person like me, a mortgage lender, and we will put together a loan. Well, a lot of folks say, you know what? How about I just get a reverse mortgage to purchase? And how would that work? Well, instead of putting $400,000 down, now I'm just using rough figures. It's probably going to be, I don't know, just rough figures for now. So we'll say the reverse mortgage covers 50% of the purchase. Now, all of this is going to be determined on your age. So, we would work up a full, pre-approval and all that. But for the sake of putting this together and just giving you an idea of how the concept works. So with a reverse mortgage, you have $400,000 purchase price, just like you did on the other place. Well, instead of putting $400,000 down, you put $200,000 down. You take the other $200,000, you put it in your pocket. And then the other $200,000, we come in with a reverse mortgage. And guess what? You're in a situation now where you never have to worry about making a mortgage payment for the rest of your life. And you got $200,000 cash in the bank. Folks look at that situation and they say, well, what the heck am I doing here? Am I going to live 30 years to pay this thing off anyways? We don't know. Or do I want to make a mortgage payment? Now, I'm biased. Of course, I have a biased opinion on this. I'm the guy, putting these reverse mortgages together. But I don't think you should be paying a mortgage payment if you're 62 or over. I don't think it's the wisest use of your funds. And I'll tell you why. Because if you're making a mortgage payment after the age of 62, you're taking it from one of two buckets. And these two buckets are very important when it comes to retirement. Bucket number one is your income. When we're younger, we have time to start over. We have time to accumulate wealth. We have our careers. We're working. Once we retire, a lot of times we're on fixed incomes. And people are scraping by, they're trying to get by on Social Security. If you're lucky and you have a pension, pensions are the most beautiful thing. Any type of passive income is incredible when it comes to retiring. Investment properties, annuities, pensions. But most people are on Social Security or maybe a small retirement that they have. Why would you want to take those funds out if you are scraping by to make a mortgage payment? And then the second bucket would be your life savings. I cannot begin to tell you how many folks that we've worked with that are depleting their life savings so that they can make a mortgage payment. That is a recipe for disaster. Your life savings becomes your crown jewel in retirement, mainly because you don't know how long you're going to need it. You could live to 70, you could live to 80, you could live to 90, you could live to 100. Well, the difference between 70 and 100 is 30 years. So you have no idea how long you're going to need that nest egg. It should become your crown jewel. And I'll tell you, if it were up to me, not a single client of mine would ever have to touch it. They would just pass it on. And I know there's people out there that, I want my last check to bounce. That's great. That's great. But if you are looking to pass on a higher net worth, don't make a mortgage payment. That's the best way to do it. Either pay the loan off and live there forever, or get a reverse mortgage and start putting that money you'd normally be putting into your monthly mortgage payment and put it into a savings, put it into some sort of an investment account. But don't take it out of your savings so that you can pay your mortgage. It's just not a good, it's not a good plan. It's not solvent. And of course, all my opinion. Okay, let's move on here. So how do older adults unlock equity with a reverse mortgage? Well, number one, they can do a combination of any of the following. They can get a lump sum. So a guy shows up with a suitcase full of cash and a trench coat and handcuffed to his hand and opens it up for you. Maybe not quite like that, but you can get a lump sum. You can also get a line of credit. So this is a non-recourse loan. And the difference between a regular line of credit and a reverse mortgage line of credit is there's two differences. One, you don't have a required monthly payment. So let's say you open up $100,000 line of credit and you borrow 50 just to do remodeling or go on a cruise around the world or just to live off of. Well, in a normal situation, you got to pay that $50,000 back every month. So you got to crack that nut, make the payment every single month for that $50,000. While on a reverse mortgage situation, you can still do that same thing. You can still pay the loan off. You can still pay it down. You're just not required to. So if you want to take that 50 grand and say, you know what, I'm just not going to make that payment out of pocket. I'm going to let the loan amortize negatively, and I'm not going to have to come out of pocket for it. So that's one way to approach that as well. And two major differences between a normal line of credit and a reverse mortgage line of credit. The other way that you can harvest cash is basically from monthly loan proceed payments. So it's called a tenured payment, and it's a lot like setting up your house as an annuity where the funds pay you back each month. Again, not a very popular option because you don't get that much back. It all depends on the term. We can set it up if you're trying to like bridge the gap for 5 years, maybe you get a lot back, but we can set up for 5, 10, 15, 16, 17, however many terms you want. But again, it's not a very popular option with at least my clients anyways. So reverse mortgage line of credit, I mentioned that you do get growth over time. So these are just some ballpark figures, okay? Rates change on a daily basis. So I don't want anybody coming back and saying, hey, that wasn't accurate. Well, rates change on a daily basis. They're a moving target, but the concepts are still the same. So I just want to be clear about that. So as a 72-year-old client, let's say you got a home value of $460,000. You've got an available credit line of $209,000. At age 100, that home value, and this is based off of 4% appreciation. And, we go over these figures a lot because real estate generally, 30-year average in a healthy market is about 4%, possibly more. We were in 20% range here in some areas of Denver just within this decade, within the last 10 years. That's not sustainable, and it hasn't been sustainable. In fact, we're at about 5.9% appreciation year over year, and that's with a very slow market, very high interest rates. That's why I think that if rates drop, prices are going to go through the roof. And in my opinion, just my opinion. But look at the growth that has occurred here on the line of credit. So, it was started off at $209,000 and ended up at $891,000. So that's a very unique feature of the reverse mortgage is that line of credit. And it does go up year over year based on the interest rates. Well, where are rates at right now? We were in the 8s. We're coming down. Things are coming down a little bit. It's good for business here. As far as the forward mortgages, reverse mortgages, rates, they affect how you qualify, but they don't exactly affect the actual consumer because you don't have a monthly payment. Now, if you got a monthly payment and your rate goes up, yeah, you're going to be concerned. You know why? Because you got to pull out of pocket. You got to take cash. You got to earn more income to make that monthly mortgage payment. Well, what if you don't have a payment that's required? Does it matter if the rate goes up? The biggest thing that this program does for folks is it gives you peace of mind. That's really the peace of mind and control over your own assets. When you're stuck and locked in that 30-year fix, you don't have any control anymore because the bank is dictating to you how they want you to pay them back. They're saying, hey, you're in a 30-year fixed. We're going to go ahead and charge you 50% of the interest up front. Are you okay with that? Yeah, we're okay with that. Okay, so that means your first year, 5 years of payments, almost all of your payment is going to go back to making sure that the bank stays solvent and rich. Is that okay? Yeah, that's okay. That's basically what we sign up for. So I digress. The line of credit grows over time. So this is a sample amortization of the line of credit. This is something I print out for all of my clients. It's a very valuable sheet that I think a lot of people like to see because a lot of people are concerned about, okay, well, how much is the balance going to go up over time? How much is the line of credit going to grow over time? Well, as you can see here, year one, we're at 209,000. It's increasing every year. 10 years after that, there's a $339,000 balance on the line of credit. This goes all the way to age 100 when the balance is 891,000. And an important part of this is that it only grows on the balance that you don't take out. So just keep that in mind. So how fast does the loan balance grow? Am I going to go upside down on my property? You know, one of the misconceptions that I see a lot with this program is that folks look at this and they say, gosh, I'm going to go upside down in the next year if I take one of these out. That couldn't be further from the truth. You know why? Because the bank will lose too much money. People don't look at this from an actual standpoint of the bank. This is a cold, hard world, the banking industry. Is it going to make money? Yes. Okay, go for it. Is it not going to make money? No, don't go for it. It's black and white to the banks. Hedge funds, banks, money is it profitable? Yes. Not profitable? No. So what do I mean by that? Well, this is what I mean. Is that the bank does not want you to go upside down on your house. You know why? Because if you go upside down on your house on a reverse mortgage, guess who loses in that situation? The bank. The bank loses. And you actually make out ahead because now you've borrowed more on the property than what the actual property is worth. So, that misconception that the bank wants to take your house or they want you to go upside down, it's just the silliest notion I've ever heard. But, you get folks out there, I know there's a lot of quote unquote financial gurus who have opinions about this program. And that's what they're telling people is that, the bank wants to take your house. They want you to go upside down. They must have never had a loan or worked with a bank in their entire life. Because I'll tell you one thing right now, I've never seen a bank operate that way. I've never seen a bank, sit in their board meetings and say, hey, we've been thinking and we want to find out how much money we can give away to people today. We want to find out how much we can lose today in profits. It's silly. It's silly. But that's what you have a lot of people telling people about these programs and things like that, which is why I'm here doing my thing to explain this program in the simplest way that I can. But to answer the question a lot of people have about going upside down, again, I print out one of these amortized schedules for every single one of my clients. Now, one of the things that's going to increase the loan balance over time is your interest rate. And also how much you're being charged to do these loans. That's one thing I would want people to know. And this is not a secret or anything that the person that is originating these, they probably don't want you to know this. But there's two ways guys like me and girls, not girls like me, but guys and people make money off of their clients on these loans. Number one, the origination fee. In my opinion, if you're paying anything more than I would say $3,000 to $4,000, you're probably paying too much. They recommend, and most people charge $6,000 to originate these. And then number two is your margin. Now the margin on the interest rate, if I give you a higher margin, guess what? I make a bigger commission and you get less money on your loan. How many reverse mortgage people have you had explain that to you? Probably not very popular talking point, I would imagine, with them. But that's the truth of it. So one thing that I've always tried to do, and the reason I actually started my own company was because when you're splitting profits with a big company and you have to, you basically make a commission on a loan, and then you got to take half of that commission and share it with the company. Boy, that's a little disheartening. You do all the work and then you got to share 50% of your commission. So what ends up happening in those scenarios is a lot of times people get overcharged because the loan officer is only getting a small sliver of 50% of the commission, sometimes even lower than that. Well, at Chariot Financial, one of the reasons I went off on my own is because I didn't want to do that, and I was tired of doing it. So I said, you know what? I'm going to charge a fair, honest price for these, and I'm going to pass the savings on to my clients. And that's one of the reasons why we're still thriving, even though there's a downturn in the market right now. My business is 100% referral, and I aim to keep it that way forever. I know that, I know AI is taking over and the robots are taking over and everybody's going to pull out their phone and get their mortgage from it. But I'm not going to sign up for that. I like to do business face to face, belly to belly. So common clients that we see are folks who are struggling to make their mortgage payment each month. There are folks that are trying to create folks that are trying to create a safety net for their assets. Again, those are folks who own their home free and clear. They want to take out a line of credit and just let it sit there. They don't necessarily plan on taking any cash, but if they need to, they can take it out of that. It's available to them. Again, equity is great to have, but it is a lot like having a glass coffee table full of cash that you can't get to right there in the middle of your living room. Well, what the reverse mortgage does is it gives you the option to take out little cash from a little drawer, take it out if you need it. If you don't need it, then you just leave it there, and it will grow over time, as we've seen. So reverse mortgage as a retirement tool. Harlan Akela, he's one of my most favorite people in the whole world. Well, maybe that's a stretch. I don't really know him that well, but I did get a lot of training from him at my previous company. Great quote from him. Awesome book that he wrote as well. So if you want to look him up. Too often, all of us focus on the price, the cost, instead of value. For a retirement plan, as in any endeavor, it is important to assess what the goal is, not just small pieces of the effort. Very few people have the goal of dying with the most equity in their home, but most advisors and their clients make decisions that reach that goal by default. In reality, it doesn't make sense to put hundreds of thousands of dollars into an illiquid asset during our retirement years, but our culture is very used to doing just that. What can I say? Harlan hit the nail right on the head. It does not make any sense to put money into an illiquid asset. So you're taking money from your savings and you're saying, okay, well, why don't I just I've got a big stack of $100 bills here. How about I hand most of the stack over to the bank? Here you go, bank. This is yours. I know I worked my whole life saving this retirement. It's my money, but I want you to have it. And then a little sliver of it, they'll take of that big stack and say, okay, well, I'll tell you what, you got $100, you got 100 hundreds here. We'll go ahead and put 90 of these in my pocket, in the bank's pocket, and then we'll take 10 of them, and we'll go ahead and pay off your loan with that rest of that 10. That doesn't make any sense to me. It does not make any sense to me. And maybe I'm crazy. Am I crazy? Am I finally losing it? Or have I lost all my marbles? Well, that's all the time we have today. Thanks for tuning in. Once again, my name is Zach Smith. I own Chariot Financial. Please like and subscribe this video. If you're seeing it, like and subscribe our YouTube page. You can reach me anytime, 24 hours a day. I am dedicated to serving my clients and educating people about this program, even if I'm not involved in the transaction, even if I don't have anything to gain from our interaction. You can contact me because it feels good to be of service, and that's what I would love to do. You can reach me anytime. ChariotReverse.com, ChariotReverse.com, ChariotReverse.com. I hope you have a blessed rest of your day, and may blessings rain down on you like 1,000 suns. Thanks a lot.